Ο σκοπός του ALBA είναι ουσιαστικά στο κομμάτι της ναυτιλίας να βοηθήσει τους φοιτητές μας να διευρύνει το επίπεδο γνώσεων. Εγώ στο κομμάτι της Ναυτιλιακής Χρηματοδότησης, ειδικά το οποίο ουσιαστικά ηγούμε και διδάσκω, το κομμάτι της Ναυτιλιακής Χρηματοδότησης είναι ιδιαίτερα σημαντικό. Η ναυτιλία είναι ένα industry, μια βιομηχανία η οποία χρειάζεται πολύ μεγάλα κεφάλαια. Οι Έλληνες εφοπλιστές έχουν κατορθώσει παρόλες τις αντιξότητες να προσελκύσουν κεφάλαια στην ελληνική ναυτιλία. Οι επενδύσεις που γίνονται είναι πάρα πολύ μεγάλες και το πιο σημαντικός τρόπος χρηματοδότησης ο οποίος διδάσκουμε και στους φοιτητές μας και στο industry χρησιμοποιείται είναι χρηματοδότηση από τραπεζικούς οργανισμούς. Έχουμε βρεθεί σε μια περίοδο στην οποία η ναυτιλία αντιμετωπίζει προβλήματα όσον αφορά τα ναύλα τα οποία εισπράττουν οι εφοπλιστές με τα βαπόρια τους, με τα πλοία τους. Παρ' όλα αυτά, για τους εφοπλιστές οι οποίοι ακολουθούν μια σωστή πολιτική επενδύσεων, το λεγόμενο σωστό timing, το οποίο είναι απαραίτητο στην ναυτιλία, πόροι χρηματοδοτικοί υπάρχουν πάντοτε και ουσιαστικά μπορούν να αντλήσουν κεφάλαια για νέες επενδύσεις.
Τώρα πώς θα αποτυπώνετε τη σημερινή κατάσταση για το μέγεθος της ανάγκης αλλά και τις επιλογές ανέβρεσης κεφαλαίων των ναυτιλιακών εταιριών?
Οι ανάγκες, όπως είπα και πριν, είναι ιδιαίτερα μεγάλες. Το πρόβλημα ειδικά στην Ελλάδα είναι ότι οι ελληνικές τράπεζες, που είναι ο κορμός για αρκετές οικογένειες Ελλήνων εφοπλιστών, έχουν ιδιαίτερα χτυπηθεί από την ελληνική κρίση. Άρα ουσιαστικά σε μια τέτοια περίοδο θα πρέπει κάποιος να προσπαθήσει να προσελκύσει κεφάλαια από το εξωτερικό. Υπάρχουν τράπεζες στο εξωτερικό οι οποίες προσπαθούν από την πλευρά τους να βοηθήσουν εταιρείες ελληνικών συμφερόντων να επεκτείνουν τις επενδύσεις τους στην ναυτιλία. Είναι πιο δύσκολο από ό,τι στο παρελθόν. Παρ' όλα αυτά για project, για επενδύσεις οι οποίες είναι σωστά δομημένες, σίγουρα κάποιος θα μπορέσει να αντλήσει τα κεφάλαια τα οποία χρειάζεται για να επενδύσει.
And I urge you to pursue quality at all times. Today we have managed to bring these two catalysts together, quality and capital. We are honored to have with us high quality and well-respected guest speakers with deep knowledge and expertise on maritime capital matters. We have with us Mr. Dimitris Anagnostopoulos, the first gentleman sitting on the left, of Aegean Baltic Bank. We have Mr. Antoni Argyropoulos of Seaborne Capital Advisors, and we have Mr. Nikolas Arachovas of All Seas Marine. Gentlemen, thank you. It is a big honor, it is a big privilege to have you here with us today. So we will start with the presentations of each of the guest speakers, and at the end of the presentations we will have a 20-minute Q&A session. So our first speaker will be Mr. Dimitris Anagnostopoulos. Mr. Anagnostopoulos is a board member of the Aegean Baltic Bank. He is one of the most respected and well-known ship financiers globally because of his long experience in the industry, having started in the mid-1970s. He started working in 1972 at the Athens University of Economics and the National Investment Bank of Industrial Development. He then worked for 4 years at the Onassis Group in Monaco, and thereafter he held various posts with the Continental Illinois National Bank of Chicago, the Greyhound Corporation, as well as with ABN AMRO, where he spent nearly 2 decades as a senior vice president and the head of shipping. Mr. Anagnostopoulos has been a speaker and a panelist in various conferences in Europe. He is also a regular guest lecturer at the City University Cass Business School in London and at the Erasmus University in Rotterdam. He is also a member of the board of directors of the Nasdaq-listed Synergy Maritime Holding Corporation, and also a member and ex-vice chairman of the Association of Banking and Financial Executives of Greece. Also, in 2008, he was named by the Lloyd's organization as the shipping financier of the year. Mr. Anagnosopoulos.
Thank you for the invitation and for the nice words. When you have a long CV and you hear the words well respected, etc., that means age. So I'm very jealous of you because I want to be better be in your age and your position rather than my position. But anyway, I will try to cover in few minutes, 20 minutes I'm allowed, I guess, a few things about raising capital through debt, through the banks. And for that reason, I will give you certain important points. Shipping is one of the few industries that has real components, real economy, real assets, vessels, that they are run by real people, dedicated, specialized, and at the end of the day they transport 90% of the world goods are transported by ships. The 85% of the wealth of the shipping companies is reflected again with real assets, vessels, and products of added value. The shipping community has mastered whether the market is up or down. At the end of the day, it is mastered by ship owners and all the players of shipping, and they move ahead irrespective of the market cycle. The shipping players and shipping companies are the ones that basically acting with simple business principles, they manage to take the opportunities and make money. You have to know about the playing field, which is we're talking about a world fleet that keeps growing. 2011, 12, 13, 14. We're talking about 1,672 million tons dead weight. You see the order book on the right. We're talking again about it's not exactly falling, but in 2015 we have these deliveries. In 2016, those deliveries. Okay. And in 2017, the order book is getting lower. However, we don't know how many new orders will be placed in 2016 and 2017. Then we have to know who are the major shipowning countries in the world. Korea counts for 4%, China for 9%, Germany 9%, Japan 16%, and Greece is the first country with 17.7% of the total fleet. The Greek fleet grows again. 2011, 2012, 2014, 2014. Greek order book follows the same pattern like the world order book. Again, there are plenty of orders that Greek ship owners place in the market. On top of that, Greece is the number one export industry. It's not tourism, it's shipping. You see the net inflows every year is about 6 billion, even those years. That is the net inflow that stays in the country. We have the gross amount coming in, the expenses, and the net that stays in the country. Where this money goes, operating expense of shipping companies, investments in Greece, stock market, industries, charities, tax obligations. Then you have to know that the market is volatile. Therefore, revenues come in and going out. In 2008 was the in 2008 May was the peak before the Lehman Brothers event. We've seen very low freight rates in the past, and then another low February and March. Now the market is down. That peak is bound to be repeated eventually. The same applies as a sample for tankers. When that goes up, go down. That's important. You have to know, and this is maybe the only slide that is worthwhile keeping. It shows how the industry moves. When we have the peak, when we have high demand of ships, freight market is high, everybody is happy, equity strong, leverage low, returns, optimism. Then market goes down, starts to go down, ordering of new buildings, aggressive lending, relaxed terms, etc. Then we have a little bit lower the market, equity starts evaporating, companies become over-leveraged, banks start taking provisions, borrowers, charterers start defaulting. Then at the real low market, and we can say here that it was low 2009, 2012 as an example, that there is low demand for transportation, is a surplus of ships, freight market is low, negative cash flows, leverage high, pessimism, investors and banks in panic, provisions write-offs, industry reputation high risk, lenders exiting. Then gradually we start going higher up when we have investors and banks target high returns, lower loan provisions, light seen in the tunnel, rationalization. And then again we see capital, banks coming in, and again financing is coming in. Just a view of what is the world ship finance market today. We're about top 40 finance banks that finance about 391 billion of ships. Top 40 banks. And you cannot read very well on this table, but I think the largest bank is DNB, HSH Nordbank, the Core Bank, Bank of China, and you see all the various financiers. Then we go to the Greek lending side. Out of the 390 billion financings of the world fleet, we have about 61 billion that are spread among these banks and lend to the Greek-owned fleet. You can recognize Piraeus Bank, National Bank of Greece, Alpha Bank, Eurobank, and a small bank, Aegean Baltic Bank. This is the real thing now. The Greek banks, the finance shipping. Piraeus Bank, which is the largest bank today, basically because she has acquired 2 or 3 banks, willingly or unwillingly, but that is the fact. The National Bank of Greece 2.7 billion, Alpha Bank 2.4 billion, Eurobank 1.1 billion, and again a small portion for the Aegean Baltic Bank, which counts for 3% of the total lending. Situation 2010-2015. We have bad lenders versus bad borrowers. What can I say about that? The banks have all sorts of casualties and must keep their capital adequacy, strive to get deposits and reduce lending. Lenders struggle to avoid provisions and write-offs. Borrowers struggle to keep afloat, employ their vessels and restructure their debts. Investment and hedge funds emerge as equity and debt providers. It's very simple to see a balance sheet of a bank today, that everybody is talking about recapitalization. We have deposits that are flowing out. So when deposits are flowing out, you need either capital or you need to reduce your fixed assets and your loans. This is the battle today, at least in the world scene, in the European scene, but most importantly in our own country. The importance of the capital adequacy for the financial institution is that regulators worldwide are trying to ensure that banks have sufficient capital to keep strong, to protect the depositors and the rest of the economy. Through the years, they have put various financial ratios and they control how much capital is in the banks, which allow the banks to lend money, which money is lent from deposits from the customers, from you, and from the capital of the bank. I will not go to details of this, which I have written in this presentation, which you will have to study, but I will go for something which is quite important. The difference between the in the 81-86 period, when the market had a crisis, a large number of vessels went to auctions, and banks would very easily to go and execute on bad loans, because they had ample cash provisions to write off loans. The difference now in today's market that has taken place after 2008 was that the banks, they had no easy way to take provisions and take write-offs, as that would jeopardize their capital structure, and they were not allowed by the regulators to do so. So they had always to go to their governments and take rescue money. So you will be seeing the various types of banks that we have in our environment. They are solid banks, and I have all the ingredients of a solid bank: all conservative, selective to choose their clients, keep exposures manageable, strict adherence to their policies and procedures, and usually have learned their lessons in the past. In their behavior, they know the customers, they're not dragged by euphoria or pessimism, they bear the crisis with good understanding of the client's needs, and most of them will restructure debt if need be and will seldom go to foreclosures. New banks, or immature banks as I call, they have no good knowledge of the market and their client base, have never experienced bad markets, short or no memories at all. They are aggressive in lending with under-collateralized portfolio. They may close and leave, taking up their losses. Their behavior, investment banking type of behavior, hit and run, abrupt enforcement of loan documentation. They keep law firms happy and can contribute to general market disruption. During a market downside, again, we have the type of owners. They are solid owners, traditional conservative, know to operate a vessel, low or no leverage at all, cash rich, value their name. Behavior, they can afford to wait until market recovers, lay up ships, there's a typo here, lay up ships or break if they don't make sense economically, and look for new investments and opportunities. The new entrants, a lot of banks that are opportunistic and they enter just to grab opportunities. They have very little experience in managing vessels, usually manage others' money, medium to high leverage, cash poor, and debt probably going into default. The behavior of those owners, they stick to the vessels, charter them at any price, attitude more like an investment banking, and has collections from insurance claims, struggling to restructure their debt and maybe to clash with their lenders. All in all, I want to say the following about the needs which Mr. Argyropoulos will elaborate, and Mr. Arachovas, that what is the Greek fleet financing needs. We have the world shipping finance, which is approximately 775 billion. It is the 400 we talked before on the 40 top banks, another 75 from smaller banks around the globe. We have the European banks that account 75 of that, about 356 billion. They form a very large part of the world portfolio. The Greek fleet is financed by 61.5 billion, and the Greek bank's share to that big pie is 10.5 billion. The order book needs a capital expenditure of about 5.5 billion, of the Greeks. The Greek second hand needs about 9.1 billion. So both these amounts go up to 19.3 billion for 2015. So normally in a bank situation you need about 6% bank loan. Therefore the need of Greek shipping, of the Greek fleet to be financed in 2015, it's about 11.6 billion. This would come from banks, from funds, or from the capital markets. And you will hear all this from my friends, Mr. Argyropoulos and Mr. Ara.
So, thank you, Mr. Anagnostopoulos. That was a very good overview of the debt ship financing industry. Now, let me introduce you to our second speaker, Mr. Anthony Argyropoulos. So, I will be reading through his short bio, which effectively is a very interesting career path that he has followed. Mr. Argyropoulos is the founder of the Athens-based firm Seaborn Capital Advisors. The firm provides general investment banking services to companies in the seaborne, transportation, and the oil service maritime industries. Sorry, let me actually put this presentation now. So the firm provides general investment banking services to the seaborne transportation and the oil service maritime industries. It also provides general corporate finance advisory work in the areas of mergers and acquisitions, capital structure considerations, restructurings, as well as research. Prior to Seaborn Capital Advisors from 2004 to 2011, Mr. Argyropoulos was a partner at Cantor Fitzgerald, where he was responsible for the group's investment banking activities in the maritime sector.
Yeah, I wanted to tell you that I did graduate from Degree College, but I didn't want to say the year, but unfortunately it's in my bio, so I think my colleague Kiki is here. We should delete that from the normal bio. Okay. What I would like to do is basically give you a little bit of insight into what we generally call capital markets. They are basically the market for capital, and that can be equity capital as well as debt effectively capital. How the capital markets work is that there is the sell side and the buy side. Okay, that's the lingo that you hear, at least in the United States. And what the sell side does is it's companies that want to sell securities. Securities is not basically things that make you safe. It's bonds, convertible notes, stocks, etc. So the shipping companies on the right sell securities through an investment bank that you see there in the middle of the Chrysler Building in New York to investors. The investors are generally called the buy side. It's the capital markets is the entire activity of issuing securities from corporations to these buyers. They are typically very, very large institutional investors, and we're going to see some of their names. So they buy the securities for investment purposes, and of course the companies sell the securities for corporate purposes, such as buying more ships in shipping or paying off their debt and other corporate reasons, but usually for expansion. Now, since I've been dated now, I can tell that I was around in 95 in shipping when there were only 4 shipping companies in the public markets. And when I say the public markets, I mean that they were U.S. Listed in the United States, either on the New York Stock Exchange or the NASDAQ. Since then, as you can see, there's been a very large increase in the number of public companies, up to about 40 or so by the mid-2004s. I was instrumental in taking, one of the first ones in 2001, a Greek company by the name of Stelmar Shipping, and then many of the others following that. Now, this graph may look very nice because it shows that there is a footprint in the shipping industry in the United States, whereas before you only had 6 companies. And as a matter of fact, in 2001 here, when General Maritime and Stelmar actually went public, and we went to the institutional investors, nobody knew anything about shipping, what it was, what's a time charter, how ships work, nothing. And frankly, nobody cared in particular because the returns for the prior years were very, very poor. Anyway, we had a big expansion over the last, I would say, 10 years, 10, 15 years. The problem, though, is that 42 companies are too many companies for this sector, and they're too small, typically. And that's a complaint that the institutional investors, the buy side we said before, has about the shipping industry. So let's go to the next. And you can see this with this graph, which basically shows you the size category from, the top size being the bigger companies and the lower, the red, being smaller companies, which in fact have an equity market capitalization, which means their share price times the number of shares that are outstanding out there, being less than $50 million. I refer to these companies as private companies that are publicly listed, because a true public company in the United States is judged by its ability to access the capital markets. This means to raise additional capital. And if you have a company, for example, like in the blue area, that are north of $1 billion, then you can access the capital at a much lower discount, more efficiently, larger size of capital, more readily, and many, many other benefits. The other companies that are in between, I would say sub 500 million, which is unfortunately almost half of them in the shipping industry, do find it hard, even though they are not private companies with a public listing, they're more public companies in the true sense of the word. They find a hard time to raise money. In a slide after this, not exactly after what we can turn, you will see that institutional investors, the top 30, have invested about $7 billion in shipping. So if you have a market cap that, the neighborhood of $300 million, and let's say $100 million is owned by affiliates of the sponsor, the ship owner, as we say, then the only true float is $200 million, and that's too small for big institutions to play. Here, very quickly, this is taken from my friends at Barclays, just to give you an idea, a slide they would show, for example, at an investment bank to show you the current status of the IPO market. And of course, on the blue lines at the top, with the laser, okay. I know I see you're dyking, so you can see here the number of issues every month, right? And you can see how January, February of this year has a slow start, but the same we expect it to warm up. And then what are the IPO sizes? In general, the same small cap sector has dominated the market. The blue line here, less than 100 million IPOs. Those are small. Typically, you need about $200 million. And of course, then they have the various industries that have been more active: healthcare, FIG, which is financial services, REITs, technology, etc. All these industries are competing with shipping for capital. Okay, and then you see, for example, the health of the IPO market is gauged by how many companies price in the middle of the range on the green line. Usually, when you price an IPO, you have a $2 range. So say $10 to $12 indicatively, right? But the market may want to buy that transaction at $9, so you price below, or you may want to buy it at $15, so you price on the purple line above. And then it's the aftermarket performance, where investors rewarded for taking the risk to buy a company that hadn't been public before. The answer is yes. The dotted lines are the S&P 500 performance compared to the IPO performance, which is much better, as you can see from the yellow lines. So let's go to the next slide. All right, here we're going to do a little bit, there's a test afterwards. So. Okay. This is basically, in a very, very, summary way, how you price a company that is not public, right? And a company specifically in shipping. And you guys know what EBITDA is, I imagine, right? Yeah. So you start with the EBITDA of this company for next year, which is 2016. And generally speaking, you start with what's called the earnings multiples. The two key ones are the EV, enterprise value to EBITDA, and dividend yield. and you backtest the valuation based on the asset-based multiples, primarily priced to NAV. Okay? So let's assume that your comps, meaning the other public companies out there, let's assume that this was a tanker company, trade around 8 to 9 times EV to EBITDA, forward EV to EBITDA. So you put this range there, you put the EBITDA of the company, you get a enterprise value, fully delivered, and I explain what that is. You subtract the debt, you could add, this is net debt, so net of cash, and you get the post-IPO equity value fully distributed, meaning this is where you would trade if you were trading exactly like your peers. But you're not your peers, you're not public anymore, so you're going to get whacked with a discount just to entice people to buy the stock. And the discount can be 10, usually 15% is typical. So now you have the equity value not fully distributed but at pricing, so what this company will actually be priced at the day of the IPO. Let's assume now that the sponsor of this company, XYZ ship owner or fund, had the net asset value of the existing fleet that comprises of this company is $340 million. So we take the $678 million in the middle column, we subtract the money we raise from the outside investors because they will obviously own a piece of the pie, and the existing owners end up with $478 million. Now that's a little bit of a trick, and it's called dilution, but in any case, in some cases with an IPO you can end up pricing, this means receiving shares in the public company worth a multiple of the net asset value you have in the ships, meaning if you sold the ships, paid your debt, you would get $100. The IPO date, you get stock worth $150, let's say, dollars. And then, of course, you work out the ownership, the number of shares, etc. In this particular case, you retained 70% of the company and sold 30. Going to the right-hand side, here we see the enterprise value again. There's a laser thing. Okay, over here. Now this is the EV to EBITDA multiple, which you notice is lower than this one because this is the multiple at IPO, because it includes this discount here. Okay, and then now you compare with the comps. Let's assume the comps are at 850, so this is 8% cheap. You may have to go to 10% cheap in order to price. Okay, the same thing with the net asset value. Well, here it says the comps are at 220. Normally you wouldn't see this big difference, but it has to do with leverage as well. So on a non-levered basis, which is EV to asset value, not price to net asset value, you see that it's more or less fairly priced here, and it probably needs to come here to have a decent enough discount. And of course the yield has a premium, meaning discount, meaning that the comps are at 7%, this is 6.8. In general, the one thing I want to leave you with is that because shipping is relatively commoditized, meaning all the companies that have ships, they rely on the market to generate profits more so than a value-added management team, if you will. You have to have a good story. This is what Americans say, and you have to price it cheaply. Okay, and this is more on the whether it's cheap or expensive as opposed to whether the story is good or not. Quite a few things to say here, but I'll keep it brief. The bottom line is this is the dry bulk enterprise value to EBITDA on the top left. You will notice one thing, and that's consistent. Unfortunately, when we have multiple expansion in our business, it's because the charter market is very low. So it's not because our growth rate expands like in the tech industry or what have you. So in the dry bulk area, you can see how in 2010 and 11, when rates were relatively solid, the multiple was lower compared to what happened in 2012 to 13. Then we had a rally, if you recall, in late 13, early 14. Multiples collapsed again and again. They're on the way up because of the situation. Tankers the same. You can see how they peaked when the market was at its lowest, and now they're very low because the market is more or less at a peak. Again, 8.3 times average for dry bulk and 10 times average for tankers. I'll get back to that on the next slide. This is the price to net asset value chronically. You know, you can see generally stocks do trend the asset values. Sometimes there are big gaps because the shipping market, the shipping industry participants value ships, and the institutional investors value the equities. Okay, so as a result of that, just like now, we've had a very decent rally in tanker stocks, in tanker rates, but tanker stocks haven't followed. So there's a big mismatch in the valuations, and you can see, for example, there that they're now trading at a lower, on the lower end of the valuation range because of that. Broadly speaking, again, 95% for dry and 130% for tankers. We saw that on the previous EV to EBITDA multiple slide. That's because of the higher level of profitability in the tanker space, more consolidation. And you can also see this in the container and gas areas where the multiples are better. So, how do you take a company public? Quickly, it's about a 6-month process. You have to go to something called the SEC that you probably know about. And what the SEC basically does is a gatekeeper. It wants to make sure the prospectus, whatever you've written in it, fully discloses all the benefits and risks and situation at the company. You work with your auditors. This is typically about a 3 to 4 month process, and then you go on a roadshow. It used to be almost 3 weeks when I did the initial IPOs, when people didn't know what dry bulk was or tankers were. Now they do. So it's maybe like a week to 10 days. You meet about 100 institutional investors in group lunches, breakfasts, one-on-one meetings, and then again you price based on how cheap you are. And the next day, on the next slide, you have a new shareholder, which is your institutional investor, and you begin your life as a public company. Investor relations, analyst expectations on what you're going to earn, conference calls with your shareholders and analysts, public filings with the SEC, informational roadshows so people know about you, again, your equity research analysts, your public announcements, etc. And on the next slide, you see here the list of the investors. Who are these people? All right. Well, are very, very good institutional investors. Neuberger Berman, Fidelity, you may know. Oaktree, as you know, has, for example, a very big position in Star Bulk, which is indicated here. Kay and Anderson, Wellington, I mean, these are top-notch institutions. The only thing I would mention here is that even though these 30 investors own half of the public stocks, it indicates that our sector is still small. The pool of capital that you go for a shipping company is not as wide, dispersed. It doesn't have the breadth of the pool of capital you go for, let's say, a FIG company in the financial sector or in the broader energy sector. It's not, capital in the U.S. is not all one big swimming pool where you dig in your cup and get some money out of it. It's different pools, different pockets, and our universe is relatively small still. And let's now go to what the shipping company indices have done. And again, on the top left, you have dry bulk, which between the peak in 2007 and 2010 fell about 50%. This is an index of dry bulk stocks. And unfortunately, since 2010 has fallen another 90%. So, not that great. Tankers, on the other hand, have fallen, let me just, because, you know, I did graduate in 86, so I do need some glasses. 43% and then 25%, but they have had a rally recently. No, excuse me, those were the containers. Tankers down 30, down 29, and gas actually had a rally, and up until recently was doing very, very, very well, until we had the energy crisis here. Okay, so on the next slide, we'll see that despite all this, between 2010 and now, we had 3.6 billion raised in 17 initial public offerings. Why? Because public investors are momentum driven, and in particular in the gas sector that you see on the pie charts in purple, there was a lot of capital raised. Almost half of it was in LNG, LPG, because that was a sector that had positive momentum. On the next slide, and I'll just go quickly through these are follow-on offerings, meaning existing public companies raising additional capital. They raised almost 10 billion of that. And as you can see, it's pretty much gas again and tankers. On the next slide, we all know about these private equity transactions, quite a few, evenly dispersed between the various segments, and $12 billion of equity capital. And last is the high yield on the next slide, which is another $8 billion, again, across sectors, raising non-amortizing debt, effectively, because you have the equity capital markets and you also have the debt capital markets. So on the next slide, let me see what it is. Oh, and here we go to the performance of all these offerings, which, remember those yellow lines on the IPO performance, which kind of like looked above the horizontal line? That meant people actually, made some money. Here, you can see that except for 2006, generally speaking and broadly speaking, of course there have been success stories, investors have lost money. Okay, that's why the universe is kind of like, I call them the New York mafia, the investors, because they're a small universe of people. They talk to each other, they have an affinity for the sector, but they know that the sector is very hard one to make money in. Okay, so some thoughts here. So far, we know that the sector has way underperformed the broad markets. U.S. listed companies have been able to raise capital despite that, which is important. The public equity investors are momentum driven, and we also know that shipping cycles are asymmetric. What that means is 7 bad years followed by 3 good years, etc. It's not, returns are not evenly distributed. So also what we've done, and I've been part of this, is in the public company market, we've taken the private business model and basically try to emulate it in the public as a public company. And this means a relatively high level of leverage, lots of new buildings, throw in a dividend there to appease the investors. However, this model is highly combustible, right? In the first crisis, you hit your covenants because of your leverage, maybe you can't pay principal, then you can't fund your new building program, you start losing money on an operating basis, you cut your dividend, and of course this rubber band snaps. As a result of that, this model is good if the market is advancing, but it's disastrous, as we saw before, on the stock performance when the market is coming down. So we need a new business model which is more sustainable. We need fewer and larger public companies that have market caps of $5 billion and $10 billion. But instead of having 70% debt and 30% equity, they have 70% in equity and less than 30% debt. I would even say that probably public companies shouldn't have any debt at all whatsoever. And a $5 billion company wouldn't have that many ships, if you think about it, if they're equity financed. No capex, no new buildings, buy second hand, buy even resales, and pay the majority of your cash flow to your shareholders. And when you decide you want to buy a ship, instead of that being a management decision, it's a shareholder decision. You go back to them, you raise the capital, and you buy it. Next slide. And we can see this here. We can see that companies with high leverage, both in the dry bulk business as well as in the tanker business, basically went bankrupt. They lost all of their value. Okay, these were substantial, large companies. They were well-managed companies, but it just had too much leverage. Companies that had more leverage still lost a huge amount of value. Companies that had low leverage lost a reasonable amount of value given the highly and notorious cyclicality of the shipping market. And now let's see, though, does shipping sometimes, I'm asked, does it belong in the shipping markets, in the public markets? And the question is that, of course it does, just like the airline industry, just like other volatile industries, energy, etc. So we did an emulation of a Suezmax over the last 15 years, and we found, first of all, I'll point out the asymmetric returns. 24 quarters, the majority of the quarters, the market was on the low end of the range. Only 4 quarters was at the high end of the range, right? Same for asset values. But if you bought a ship, a Suezmax tanker, at the peak of the market, 97 million, in 99, went through whatever the rates did between 99 and 14, you still made an unlevered return of 6%. You didn't lose your money. If you bought it at 77, you made 10%. Keep clicking. If you bought it 60-15 and at the low end, 43 billion, you made 23% unlevered return. Same thing in the dry bulk. And again, you can see how symmetric the returns are. You can see that the returns are lower for a Panamax, slightly higher for a Cape, but this is because it's a much more fragmented industry. Okay, many companies, too small. Drilling sector. I have one more slide and I'll finish. Drilling sector. In 1994, right? Before most of them were probably born, huh? Or right about when you were born. In 1994, they had a market cap of 4.6 billion, and these are the top 5. And you can see they only controlled 30% in terms of market cap. In 2004, they had a market cap of 43 billion, and they controlled 60%. And in 2014, they controlled 70%, so they flipped from here. And because of the energy crisis, big sell-off we've seen in energy, the market cap has fallen, but it was like at the beginning of last year, it would have been something like 70 billion. So that's what we need to see in shipping. Okay, here I'm not going to go into this. This is basically timing, playing the asset cycle as well as the capital market cycle. And for some concluding remarks on the next slide. At the end, when it comes to Wall Street and shipping, there you go. It's all about money. Thank you.
Thank you very much, Mr. Argyropoulos. That was a very, very good presentation and a good insight and overview on the equity capital markets. Now we move to our third speaker. Our third speaker is Mr. Nicolas Arachovas, and we're very happy, particularly for Mr. Arachovas, to have him here with us, since he's a graduate of ALBA Business School. So Mr. Nicolas Arachovas is a ship finance executive with deep knowledge and expertise on ship finance, particularly on the public equity capital market side. He recently joined All Seas Marine SA as a financial advisor. Prior to that, and for a period of 5 years, he was a vice president of finance at Excel Maritimes, a well-known and sizable dry bulk shipping company that was listed on the New York Stock Exchange. And during his tenure at Excel, he was involved in the group's financial affairs, dealing with the company's banks as well as with its equity shareholders and bondholders. Prior to that, Mr. Arachovas was the CFO of IMSSA, a privately held shipping company controlling 23 tanker vessels. Mr. Arachovas has also worked at the corporate finance departments of the Coca-Cola Hellenic, S&B Industrial Minerals SA, and he has also worked with Deloitte Consulting. He has a Bachelor of Science in Maritime Economics from the University of Piraeus and an MBA with major in finance from ALBA.
So it's been a long story and it's quite sentimental for me since I graduated from ALBA. And Professor Strablos was still very instrumental back then, and I graduated in 1999. So time flies. Since we talk about age, just bear that in mind, that time flies quite fast. So the title is The Equity Capital Markets from the Ship Owner's Perspective. And I wanted to make sure, and for the record, that I'm not a ship owner. And maybe I'm not even close to becoming one. However, I've been working in shipping for the last 8 years, and I studied maritime economics back in 1992 up to 1996. So let's start. There will be an introduction and then the main course and the concluding remarks after that. We'll take it over. So ship owning, when you need to own ships, you need to find the money. There are various different sources for the money, starting with internal resources. So a ship owner may have the ability to fund the investments through his or her own funds. This is the internal resources part. Going back into a more transparent way, you should find here private equity, and you heard comments that private equity has become instrumental in the last few years when the knowledge about shipping became more intense, and to an extent some market participants blame private equity for the fact that an oversupplied market did not balance in a way, since they came in after the Lehman Brothers collapse in what they thought back then was a distressed market to take advantage of the low values. So they proceeded to counter-cyclical investments, as they call it, with the hope that the market will recover soon. For the time being, and as we speak today, the market has not yet recovered, and it's still a very oversupplied market. Indicatively, and that's something that has happened for the first time in shipping, today's fleet, the main segment, about 50% of that supply is less than 5 years old. So the fleet is quite young, and many people say that it needs time to balance and take care of the young fleet. Then we go to public equity, which is what Anthony has mentioned shortly ago, and we'll go in more detail to that. Finally, there is the secured debt, which has always been the backbone of financing, and it has been pretty outlined in details by Mr. Anagnostopoulos. So that's the main part of financing, either for private or public companies. Anthony also mentioned, made a reference to the debt capital market. So it's the ability to raise some debt, some bond, which is normally a non-amortizing instrument in most cases, or a low amortizing instrument, that has a specified maturity. Such bonds may either be secured through a mortgage on the vessels, or unsecured through the security of the corporate name. So these are issued at the level of the corporate. And there is another small category here. It's a big one, but it was mentioned for various reasons down here, that maybe bonds can be convertible to shares. These are the so-called convertible bonds that have an element of debt and equity together, maintaining the upside for the bondholder. The main topic of today's presentation is the common shares, because as the name says, they are common. So it's the most usual thing to do when you go to the capital markets. Then there are preferred shares. Preferred shares are in between debt and equity, and they normally have a specified return for the investor or the holder. They have been pretty common, or let's say favorable, in the last couple of years, when a number of shipping companies have issued such instruments. There are about 10 or 12 different preferred shares in traditional shipping companies listed in the US as we speak. And there are different classes. Certain companies have issued more than one class, which, with pretty similar, in most cases, rights for the preferred shareholder. And that's an interesting instrument to follow. Then the warrants is also an instrument that has to do with equity. Normally they are issued together with stocks. There are instruments in which, at a specified time in the future and under certain conditions, this can be converted into shares. And putting together shares and warrants normally is called a unit. Okay. So, common shares are mostly listed in the USA, as Anthony just said, but there are many significant companies in other parts of the world. In any case, New York is the capital of capital, as people say, so the most part of it is in the USA, in which unfortunately, as I've just mentioned, most of the investors have lost money in the last 5 years. The graph there shows the returns as of February 2015 versus the investments that were made 1, 2, 3, and up to 5 years ago, and most of them are pretty on the negative territory. The way I was thinking to approach it was to separate the presentation into 3 different sections. The one is the reasons to go public. So if you are a ship owner, what kind of considerations you need to put in place before you decide to be a public company, which is quite different. What does it happen if you have your first holiday or your birthday being as a public company? So which is the impact in everyday life of the shipping company. And finally, the investor watch list. So these are things that the investor needs to have in mind, so that the investor invests and the ship owner manages the business within the context of the expectations, let's say, that the investor may have. So there are more details in this slide. This is actually the whole presentation, but there will be some backup slides and support. The first section is usually go public. You see the growth platform will normally grow. Maybe a private investor needs to exit through an IPO, or maybe being publicly listed gives you access to deals. Then the impact of being public is you're more transparent, you have higher costs, you need to be, let's say, more visible to the market, as well as you have to cope with the increased volatility that means. Finally, there are certain valuation elements that also have been mentioned a while ago, whereas being public affects your financial strategy and some other factors that we'll consider. So, taking into a bit more detail. Okay. So, growth platforms. This is the case of Ship Bulkers. It's a traditional shipping company with long history as a family. This is a family of Mr. Hadjiouanou that went public back in 2008, just before Lehman Brothers collapsed, at the peak of the market as the share price soared. When they entered the stock exchange, the family, through holding company, had about 80% of the outstanding shares. So that was a low free float. And the strategy that it followed throughout the years was to make follow-on offerings, as they were mentioned shortly ago, and raise money at different levels. Today, as we speak, they have increased the number of shares by about 30 million shares at different levels. They also issued preferred shares in the summer of 2013. And today they are holding about 60% as a family of the listed company. A similar example is the case of Baltic Trading, which started as a spin-off of another listed company which is called Genco Shipping and Trading. So started with an initial fleet of 6 vessels, doing an independent, let's say, IPO back in 2010. And through the various follow-on offerings, they managed to grow the fleet to about to 17 vessels as we speak today. And that is more important to note, that despite the decline in the share price, still the growth capital mechanism was there. So they managed to grow despite the fact that the returns to the shareholders were not as exciting as they would expect. So, going back to our main slide, let us talk about size and diversification. With the case of TK Corporation, which started as an individual company back then while Anthony was here, but I was not. Anthony, you know better than that. So they started with the main vehicle, let's say, TK Corporation, and then they started spin-off businesses and in different segments and have a diversification as well. So now they are a large group of a few $1 billion overall, with a presence both in LNG and offshore and a traditional tanker company. The same case applies for Navios Holdings. They started as a typical dry bulk company and then spin off through an MLP, which initially started as a dry bulk company, and then they also bought containers, which are a great part of the EBITDA today. And they also had a tanker company that started as a SPAC. SPAC is a special purpose acquisition company, which raises money for doing the investments afterwards. So it's not a setup company; it's a new company that's been built. And following the presence of that SPAC in the market, they managed also to have an MLP as a subsidiary of the SPAC. So the group started as a typical dry bulk company, but they use the capital markets extremely efficiently, in extremely inefficient manner, so that they grow the business more. Finally, another element that we need to mention is that being public means that you have an exit strategy as an investor. And in that case, we have the case of Genco Shipping and Trading and Ochtri. Ochtri is a large institutional investor in shipping today. They made a partnership with Peter Georgopoulos back in 2013, about 10 years ago, and they invested in dry bulk fleet. They were holding back then 100% of the company before it went public. So that company, Fleet Acquisition LLC, floated the shares about 10 years ago, And gradually, after various follow-on offerings, they managed to bring back their percentage from 100% down to 10% here about 4 years ago. So what actually was the capital markets for them was an instrument that helped them exit the investment through selling hopefully at higher levels than the one they invested. And that was a very successful business for Oaktree back then. The next one is the access to deals and consolidation. Now we use the case of Starbulk, which is another dry bulk shipping company that used its shares as a currency to buy 2 separate fleets in 2014. The one was through the issuance of 54 million shares in June 2014, and the second one was the issuance of 30 million shares in August 2014. The important thing to consider here is that before issuing these shares, Starbulk was a much smaller company than it became after this issuance. So they used the shares as a currency to purchase another fleet, or a couple of fleets actually. This is something that you cannot do when you're a private owner, you do not have visibility over your finances. The latest element about reasons to go public is the personal visibility. As it has been mentioned, normally these companies have a sponsor behind them, so some of these people may want to be more visible and more recognizable in the society, so this may be a reason for which they are affected and they want to go public. Let's see the second section, which is the impact of being public. Obviously, you have higher administrative costs, you have less flexibility in decision making because certain of these decisions need to go through a general assembly of shareholders. But the most important thing is that when you are public, you normally have increased volatility, and sometimes you receive pressure to put money to work. Let's see how this has worked. And there's the market. This is quite recent data. The one is in June 2013 up to March 2014. And the lower part of the graph is the 1 year after. So what has happened back then was that the Baltic Dry Index from the summer 2013 went up significantly and almost doubled in a few months' time. As a consequence of that, orders were put to significant levels. About 25% of today's order book has been ordered back in 4 months only. So the ship owners rushed to get advantage of a train that may have left. So they went back to order a significant number of vessels. Exactly the opposite happened 1 year after. In June 2014 to March 2015, the market has been going down. You see here the level of decline from 134 as an index basis to 65. So pretty much in 6 months' time, both values, as they are measured by the Panamax 5-year value, and the BDI, which is the Baltic Dry Index, so both charter rates and vessel values gone down by 40% in 6 months' time. That was a volatile thing. And look at the behavior of the market participants after that decline. What you can see is that the number of orders, which is this number, went down from $6.8 million deadweight tons, which is pretty much the level we left it a few months ago, down to 0.2, so almost no new building orders were put. It's a kind of cycle that was described a while ago by Mr. Anastopoulos. When the cycle changes, then the market behavior changes as well. So people do not order in today's environment. There have been almost no orders, while at the same time the scrapping has moved up from about 1 million deadweight tons per month to 3 million deadweight tons in February. So it's about triple. And people are saying that 2015 will be in dry bulk, which is an element that you meet in other segments as well. In dry bulk we will have a scrapping record year, maybe surpassing the levels of 2012, which were pretty significant. As we speak, in the first 3 months of the year, the pace is double the pace of last year. So already about 8 million deadweight tons have been scrapped, whereas 16 million was scrapped for the whole year 2014. So we're running in double pace. And then people place hopes to that adjustment that the market participants are making. So the element of the capital market magnify that impact. So it's an accelerator, let's say, of the behavior because the decisions made by public companies are made public and affect obviously the decisions that our owners are making. This is when the market is volatile. Mr. Alexopoulos just shortly ago mentioned about the price to NAV. It's actually what is the value of investors versus what's the share price reflection of that value. Look at how the situation moved back in January 2012 from 61%, which is the bottom left of the graph, of the price to NAV. So in other words, you could sell your vessels at $100, but if you sold your shares at that time, you would only receive $61, which is 40% discount on the value of the fleet. Since the perception were changing in 2012 and 13, that number suddenly became, after about 2 years, 111. So you were taking more by selling your vessels instead of the value that the shareholders were putting or assigning to your fleet. Immediately after that, a similar reason for that increase in the price to NAV was the fact that the Baltic Trade Index moved up and became about double in the second half of 2013 versus the first half of 2013. So the positive sentiment that was in the market and charter rates immediately was reflected in the price to NAV multiples of the stocks. That is because, as Mr. Alexopoulos said, it's a momentum-driven shareholders base. And what the companies did immediately after is that they raised more equity. You see, in the first half of 2015, we were pretty much in the situation that we are today. In today's market, it's pretty challenging to be able to raise some funds in the capital markets if you are a dry bulk company. Obviously, there are other segments like tankers or LNG that have better prospects and are more appreciated by the investors. But someone could safely assume that a dry bulk shipping company in today's market segment cannot raise money. When that segment changed back in 2013, companies raised all of a sudden $700 million instead of 136. So pretty much all the dry bulk shipping companies raised funds in about four months, which actually drove those increase in orders as well. Because sometimes the investors are putting pressure to the shipping companies to put money to work, so you cannot raise money and without having a story about what you're going to do with this money. And that's a kind of pressure that the ship owners are receiving. Some of the concluding remarks. Public capital markets are very important for shipping, and hopefully they will still be there as they've been in other industries. The good thing is that shipping companies are adjusting their behavior to that. They are growing, they are becoming more corporate, they are becoming more transparent and possibly further to the minority shareholders. The reality is that the sentiment, generally speaking, in most segments is negative today in shipping. But it's a cyclical industry. We've seen that shortly ago about how the sentiment changed the behavior of the participants. So hopefully, despite the volatility and taking into account the fact that it will turn back, I just wanted to put something that Aristotle Onassis used to say: we must free ourselves of the hope that the sea will ever rest. We must learn to sail in high winds. So the market will still be volatile, because shipping is a product, or a vessel is a product that you cannot go out and produce in 1 month. When we had some runouts in Coca-Cola back then, 7-8 years, you increase production and you go out in the shelf and sell immediately. Whereas there are no ships to transfer, you cannot have a ship in 1 month. It's a completely different industry that has created that kind of anomalies in the past that provided either opportunities or challenges for the ship owners. So the market will remain volatile, but in any case, any downturn could be an upturn, and I would like to welcome you on board.
Thank you, Mr. Arachova. That was a very nice overview of how ship owners, although you may not be one, see things from in relation to the equity capital markets. So once again, thank you a big thank to all of our guest speakers. This was a very good overview of all the important capital sources that the ship owner is exposed to. So I would like at this stage to open the floor to our students, because effectively this nice workshop was actually delivered for you, to come up with any questions that you want to raise to our distinguished guest speakers. So any questions that you would... Yes?
Hello. I would like to ask Mr. Anagностopoulos.
First, yes.
Yes. Whether nowadays most shipping companies have their vessels under different legal entities. Do you see this changing in the future, and the shipping companies going towards a more transparent holding structure, a structure of the company?
Well, I don't understand the word different legal entities. Probably you mean offshore companies.
Yes.
I think the shipping industry is the industry that has the more genuine offshore companies for genuine reasons. I think whatever it is non-shipping and has an offshore company is tainted. That's my belief from my experience. The reason of having offshore companies shipping is because ships trade worldwide, so they are exposed everywhere. They go from civilized port to uncivilized port. There is a lot of liabilities issue, and has been a practice for many years. Actually, the beginning of the offshore companies was in the United States. Delaware was the first offshore company that was established in this world, and still is Delaware. It is a state in the United States. And then we have all the others, Marshall Islands, New Jersey, all these companies. Even in Greece, that we have the legal structure, Greek, Ελληνική Ανώνυμος Ναυτική Εταιρεία, Greek Société Anonyme, Shipping Société Anonyme, it was done for a particular reason, for a kind of taxation in the United States. I think it's very transparent. There is no intransparency in shipping, because shipping is globalized as an industry and was global before the globalization of the whole world. So everybody knows where the ship is, how much money she earns, and therefore it's very difficult to be intransparent. The legal aspect of the companies, it's basically irrelevant.
Okay. Yes, please. Yes.
Hello. I'd like also to address a question to Mr. Anagностopoulos. We have been taught that as part of the credit analysis, lenders evaluate the fundamentals of the shipping industry, the shipping cycle, the client, the project. What went wrong in the recent past that led to today's problems of the shipping banks? In your opinion, did they follow a prudent lending approach or not?
You're talking about the banks in general or shipping banks?
Shipping bank.
Basically, this is a discussion that will take us hours. You have first of all to see the entire monetary system and what is happening in the entire world. Banks these days, after the Lehman Brothers, which has been a shock to the international community, showing that there is substantial bubble money, which is not reflected by real assets, have to undergo into a capital rationalization, meaning that they have to adjust their capital and their balance sheet in a way that is real and reflects the value. We can take a very simple example when we talk about our country, because we have very vivid examples. In September 2014, our banks, the liquidity in our banking system, did not have requirements of liquidity from the European Central Bank. Today, they need 100 billion in order to stabilize the system, meaning that the banks have 230 billion in loans with 130 billion in deposits. So this means that the banks are bankrupt. So that process is a combination of the LA system that provides liquidity, but also when the banks are measured through the Basel II. Have you learned about Basel II requirements? when they measure the adequacy of the capital of the banks and they meet the gap, then they have to recapitalize. The shareholders usually, they don't put new money and they lose their own money. And then the central bank comes again to add up capital. And then the banks become, in quotes, nationalized. So all the system creates a very tight liquidity, and shipping, which is a capital-intensive industry, it's the enemy of the abundant capital, because it requires a lot of capital. And we see the majority of the banks in Europe, I would say, but not all in Greece, they try to deleverage by selling assets, i.e. loans, and in order to deflect the gap of the capital and of their liquidity. And this is the whole problem. So we have banks that they are in trouble in reality, and an industry, especially in the dry bulk, that is in trouble today. Therefore, they're trying to find balances in order for the banks to have adequate reserves, to take modest write-offs. Because each time they get a write-off, they have to try to raise capital. So there is a vicious circle that will take some time for the whole system until it stabilizes. In the United States, they found the solution by issuing paper. In Europe, we're more conservative. This is not in the ideas of the European Commission. But in a way, things will stabilize. We don't know when, but they will stabilize, and we will see the cycle again.
One more thing I would add to that is, if I understood your question in a different way, is why would banks lend kind of at the peak of the market when they have all these models, etc. Banks, and again, I don't have Mr. Nαυτιλιακής experience, basically are net lenders in the system. So if you're at a bank, you know next year $10 billion is getting paid down or matures, so I got to put out another $10 billion. Typically they want to grow their portfolio by a little bit as well, so maybe that's 11 billion. Okay. Now if the market, so they are every year they're net lenders in the market, regardless of whether the market is high or low or in the middle or whatever. So although they had tightened, I think, to some extent their standards at the peak, that lowered the advance ratios, etc., they were still net lenders. So just like ship owners got caught up in the euphoria of, it's a new world or whatever, I think the banks were also obliged to get, because if you're a good client of yours calls you and says, I'm ordering a new building, and you're a traditional client of the bank, you have to offer your services.
Okay, thank you. Okay, please.
I'd like to ask Mr. Argyropoulos about the private funds that came into the shipping industry. You stated 2 times that the shipping industry needs more capital, but excess funding drives us to excess to oversupply the market with ships. So do we need more capital? Do we need more ships?
Yeah, that's it. I'm not sure whether I said that it needs more capital. I think I said that the presence of the public companies should become one with fewer but more capitalized, better capitalized companies. The issue of the industry, as I see it, particularly for the public companies, is that they still rely too much on debt capital as opposed to equity capital. Okay, so you may have the same pool of capital, but you just change the composition of that. Now, when it comes to private equity capital, that's a very interesting situation. Typically, private equity capital is more deep value orientated, as opposed to public capital that's more momentum orientated. Public investors say, I don't care about the bottom 30% of the market, let somebody else make the first 30%, I'll make the middle 60%. Okay. Private capital usually comes into any industry, and shipping is is a prime example, it's no different, when the public markets are not available to it. So So the phenomenon of suddenly public equity capital coming in is not unusual and it should surprise us. It came in now simply because the visibility of the shipping sector over the past 10 years with all the public companies had increased. Okay. Unfortunately, a lot of that capital, not just private but also public, was channeled towards new buildings. And as a result, I think it...
6%. Yeah, so 6% approximately.
Yeah, well, it depends on the credit stats of the company. I mean, if it's... I mean, this sounds
they
relatively
have a
low.
long track record of issuing bonds in the Norwegian market, so that's probably why it was oversubscribed. Yes.
Correct, yeah.
Okay. Yes?
Can I ask Mr. Rachbas, do you believe that a stock's performance is the only thing that an investor have to see if his investment is going to have returns or not? Because this time in the tanker market, when the oil crisis, all the stocks are in downturn, are underperforming. But all the tankers and tanker fleet ship management companies are growing in profits and have new orders and things like that. But if we see it from a financial view, the stock is falling, but the company is operating very, very well with a lot of profits.
Well, obviously there's a very detailed toolbox that the investor may pick up in order to select a stock. Conceptually, the approach that someone would safely assume would be that you need to see the forward performance of the company and try to predict its financials going forward. That normally is not related to how the stock performed in the recent past. So I would tend to think that there's a forward kind of looking when you need to select. And then depending on what kind of elements an investor likes, there are a couple of different perspectives in which you can approach. First of all is the cash flow visibility of the company. So it's a cash flow perspective of how much it does earn from the vessels it has. And then there is an asset play or an NAV approach which calls for how undervalued or overvalued it seems on a liquidation basis. So each one can select the different, let's say the different elements that would be preferable to the specific investment. Generally speaking, history does not, although it repeats itself, does not represent the guidance about how the future will look like. And the main valuation factors are normally on a forward basis, so forward EV to EBITDA, the base value to EBITDA, or forward NAV for the next 12 months normally.
Okay. So maybe since we have already moved beyond the time that we had first started, I don't want to take the time of our guest speakers. Personally, just two questions, if I may. One of them I would like to raise it to Mr. Anagnosopoulos. I mean, based on your experience, you have assisted a number of Greek ship owners, especially, to raise capital and operate in the industry. I mean, without debt, obviously, even if the capital markets, the equity capital markets are there, I mean, you need debt to finance this capital-intensive industry. What, in your opinion, in your experience, is the critical factor that determines the ship owners in order to survive in the long run? The key catalyst that makes them survive.
We're entering into more philosophical. Best client for a shipping bank is the one who does not need a loan. That's my experience. Of course, the plain vanilla debt. The most important thing is when the market is good, you have to put aside your piggy bank and have some good cushion for the bad days. And when the market is bad, to be able to take the opportunity. But always, in my experience, in my career, companies that have failed were because they were either greedy, which is a bad virtue of every human being, and companies that they took shipping as a gambling rather than as a solid and long-term business. you'll be surprised how many companies exist that we don't hear about so much, that they don't borrow, or if they borrow very little, and these companies maybe they have a longer, a better possibility to live forever. And in most of the cases that things were wrong were, and this is very important for bankers, is to pay attention, especially to the Greek shipowning market, the succession issue, because usually generations change the behavior, and 50% of Greek companies that they went either bust or they went into trouble, they were from succession. The successors were worse than the people that they have created the companies or the files. I mean, that's my experience. So there's always we have to step back and take always cautious approach, because at the end of the day, one of my customers was saying, I was trying to induce him to buy some more vessels, and he said to me, listen, I have 2.5 billion in the bank and I have no debt, so why to buy more vessels? Because my life will not change if the 2.5 billion will become 3 or 4. I will live the same way. I mean, this is the that's why I said philosophical is the issue.
I think at 2.5 billion I would say the same.
Exactly. No, some others with 2.5 billion that they lost them. That's because true. They wanted to go. You have many examples. I don't want to say names. Okay.
Okay, and then, as I said, I don't want to take our valuable guest speakers' time. So may I close this interesting, very interesting workshop with just a question, actually, to each of our guest speakers. I mean, so if possible for this question to be answered, starting by Mr. Anagnosopoulos, then possibly Mr. Argyropoulos and Mr. Arachoupas. I mean, you have all been students in the past, and after you graduated, I mean, you have followed a very successful career, and so right now in front of you, you are seeing our students, the ALBA Business School students. If it's possible for you to share the secret of this success, what key advice, what key takeaway would you share with our students in order to assist them towards their self-improvement, towards their career development in shipping in the years to come? Thank you. If we may start. The key takeaway.
I don't think that I'm successful. My children say to me, if you have not become a ship owner, you failed. So, we're successful. So, I don't know. I mean, you have to work in life, and put targets and reach these targets with integrity, which is a rare species these days. I mean, if I had to hire somebody in a place, I think that is the first qualification, irrespective of graduation and universities and everything. That is, I think, the first. It becomes a rare species. So, I don't know. I told you. Anthony, tell me.
I would basically, I guess this doesn't work anyway. I would say that be persistent, don't give up. You know, they say that the difference between success and failure is that success tried one more time, as opposed to failure. Do the best you can. You know, be better than anyone else in your field. And no matter how menial or boring your job may seem at a time, you know, do the best you can so that you can, move on.
And for me, again, with all the disclaimers that I may not, be considered for the time being successful. In any case, I'm the younger, as we said before. Sorry about that. So I have only a limited perception about what can make somebody successful, but my experience up to now was always to work hard actually, but always maintain a balance between the personality and the technical skills. So I believe that in any type of job that we are requested to do, it's not the technical skills, which are the basis obviously and the fundamental, but it's not the technical skills that will make that career even more successful.
Okay.